What's up, everybody? Right before we get into the show here, just want to give a quick shout out for our next Blockworks conference. Permissionless 4 is happening June 24th to 26th, and it's a crypto conference all for the developers and builders in the space. So we're going to be hosting it right in the heart of Brooklyn, New York, and it's going to be a ton of fun. There's going to be a lot of fantastic speakers, and the whole Forward Guidance crew is going to be there. Myself, Tyler, Quinn, we're going to be doing a live roundup. There's going to be some wicked community events. Come meet us, have a beer with us. Come see some of the awesome side events, some fantastic speakers. There's new ones being announced every single day. So go ahead and get your tickets. Use the code FG10 to get 10% off and don't miss out. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And today I am very excited to be joined by Robert Bench, who has a storied career, has worn many hats over the years throughout the digital asset industry. He's been the Associate General Counsel, Chief Compliance Officer at Circle, has been the co-founder of the Blockchain Association, Assistant Vice President at the Federal Reserve of the Bank of Boston, where he was the Executive Director of Project Hamilton, which was all about exploring the feasibility of a central bank digital currency, and provided and led a lot of the research there around CBDCs, which we'll be getting into. And now is currently the founder and CEO of Radius, as well as a senior advisor at the MIT Media Lab. So, Robert, really great to have you on the show. It's an absolute honor.
Thanks for having me.
Yeah, super excited. So, skim through there your background, but I would love to just get everybody up to speed on, do a bit of deep dive on some of your different phases of your career and some of the insights and lessons and takeaways that you've derived there. So let's rewind all the way back to Circle, which is obviously very much in the news these days as they IPO'd just last week, and it went exceptionally well, which is fantastic. And yeah, I would just love to hear a bit about what it was like working there. You led a lot of the regulatory framework of Circle, which led on to be a lot of, as I understand it, a lot of the building blocks for stablecoins in general within the US. And obviously, we're at a moment right now where we have some stablecoin legislation that's working its way through Congress. So we'd love to just hear from a high level, what were some of the lessons? What did you work on there? And what were some of the key takeaways for how you think about stablecoins as an industry?
Yeah, thanks, Felix. First, I'm really excited for the team, right? This has been over a decade in the making. And the couple of things I think about on the Circle side is how directionally correct Jeremy and Sean were on can money move on new networks and what does it take to do so. And they took a pretty long path to get there between Circle Pay, Circle's BTC activities, the trade desk, Poloniex, but they were always directionally correct that money can move better with less intermediaries. So that's really, really incredible story there. And happy to talk about that. And the other thing is the story of the investors of Circle. There's been firms like General Catalyst and Fenway Summer who have been along that journey the whole way. So as a founder, thinking about what I saw David Orfeo and Raj Date and the rest of the investors in Circles do, supporting Jeremy and Sean, that was a really good lesson. On the stablecoin side, and how Circle came up with USDC, how we thought about that from a regulatory and legal perspective, it's a really interesting history of how does regulatory innovation happen, and should it happen? I think a lot of people are really kind of skeptical of regulatory innovation. So with USDC, I can talk kind of about the long arc of stablecoins and where we see ourselves in the history. When we were in Circle Trade, and that's where I started my Circle career, was with the Circle Trade Desk. Us and DRW were two of the largest crypto desks in the world. And what you really needed was some type of vehicle that could solve the FX and latency problem with BTC, right? And that if you were trying to buy BTC from, say, DRW at size, there was a major mismatch there where the BTC may not settle in a different time frame as the wires, and you have to really trust those counterparties, which is still to this day why you see trading desks get along so well, because there's a lot of trust there. But if you had a way for the dollars to move a lot faster than the wires, particularly over weekends, that was a problem Tether solved for. which was a critical need in the space at the time, not to mention the large holdings that the large exchanges had. And I think at Circle, we saw that and said, can we do it better? And Jeremy and Sean, I think, really did believe from the jump that there's ways to do better in a regulatorily compliant way. And when we built USDC, it was, can we do this with very clear backing from audit firms? So to be clear, Circle always had an attestation, not an audit, but can we show that we have the money there? Can the money be in the safest place that we're permitted to from a regulatory standpoint? And can we be transparent about that? And with USDC, we launched it with all those guidelines in place, including things like remote burn that were novel at the time, which were, if we thought that there were very bad people on the other end of the money, could we burn the money and put it into the right type of repositories? Those were all innovations we did at Circle that hadn't been done by Tether that we thought would be game changing. The most interesting thing was they weren't in a lot of ways. Tether retained its dominance on that kind of what I'll call stablecoins as a wire replacement. And to this day, they hold that dominance, right? Tether is still 90% of transactions. Tether on Tron is still overwhelming the supply of the market. What's most interesting is, Jeremy and Sean committing to that vision of money working better was really what I'll call the phase 2 of stablecoins. And that was largely led by a guy named João Reganado, who's now the founder and CEO of M0, who said, well, all right, Tether has a dominant role in this stablecoins as wire replacements. But what if you actually take use of the programmability of stablecoins? And this is where João and some of the members of the product team really understood about DeFi and where DeFi was going and why Tether wasn't built to solve the DeFi problem and where Circle could get to. And the really interesting thing was there was no regulatory challenges on the DeFi side with Circle. It was, can we use the programmability native to USDC and can we get real traction there? And that's, I think, the most important historical moment with USDC was that we had a team of people that saw where the world was going and built the product to solve that problem, which was DeFi. And that's where you start Circle USDC. And at that point, Coinbase had joined. Coinbase joined about a month before launch, where we start breaking away from Gemmy and Paxos and the other ones trying to jump into that same space. And I think that kind of being able to change your direction and understand where the world is going was really critical for Circle. And I think I think the next question for Circle was, where was it going, right? So Circle built that USDC to solve the DeFi problem. Then we had administration change in 2020. And the question was, well, what are stablecoins used for than just DeFi? And I think Circle also jumped into the question of, can we solve what I'll call non-crypto real-world problems here? And this was largely led by their new head of policy, Dante, which was, hey, remittances are a massive, nasty problem. And this is something we saw at the Fed too. Everyone agreed remittances were terribly expensive and were a tax on persons who could least afford that tax. And I think Circle, and to their credit, a bunch of other firms realized that remittances were a huge problem that could be solved by stablecoins. And while they don't show up in the real volume numbers of stablecoins, it solved the real problem. And you're seeing that continue to grow to this day. Peer-to-peer transactions aren't terribly large in the greater scale stablecoins, but they're life-changing for those who need it. And that's where I think Circle really got to that phase, what I call phase 3 of the remittance problem with stablecoins. I think there's 2 more phases that we can get to now or later that I'm not sure how Circle is going to play, but that kind of goes into where stablecoins are going to play when what I'll call the traditional card stack, the traditional online payment stack, and then where they're going next, which is where Radius is focused.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to Arkham.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Yeah, I think we can get into some of the current future prospects in a little bit, but I would love to take some of those lessons and innovations and insights that you derive through working on private stablecoins and start to tow that towards the next phase of your career where you went and worked at the Federal Reserve Bank of Boston and you led Project Hamilton, which was all about exploring the technical feasibilities of central bank digital currencies. And it was a really interesting time. Like I was reflecting myself on that phase where we started to see, during, FOMC press conferences, people would be asking Chair Jay Powell about what's going on with CBDCs. What's your perspective? What are you thinking about? And, there'd be these discussions about how there's, some technical research going on paired with partnership of MIT Lab. And you led all of that. So I would love to just hear about what was that process like? What did you learn? Where did it end up? Obviously, the you know overall it ended, and there was no further progress on that. So yeah, walk us through that whole journey. It's fascinating.
So, I mean, to start with, it was leaving Circle. And then that was hard because we had built such a great team at Circle, and working for Jeremy and Sean was such a unique learning experience. I think anyone who's worked for Jeremy and Sean would agree. But we had a really interesting opportunity where at Circle, we were a global company at that point, and we had multiple offices around the world, and we were at the cutting edge of digital asset exploration. And one thing we kept hearing about was the national interest of the Chinese government in building an ECNY. And that more than anything was what led me to leave Circle. And in light of this recent IPO, get rid of all my shares and not let my shares expire because I didn't want a conflict, which was, can I go to the Fed and try to do something to at least let us understand what our near peers are building? Because if they're building it, there might be a use case there. And can we get smart on it? And to his credit, my boss at the Fed, a guy named Jim Cunha, brought me in and gave me a lot of rope to build a team, bring in engineers from MIT, bring in engineers from Circle. A lot of the USDC team came over with me over the course of time to explore what would a digital dollar look like? What technology from what I'll just effectively call the distributed systems and cryptography world could we bring over? Can we work with the team over at MIT DCI, who I still think are the best in this space? And what can we find out? And then can that actually coexist with inside the Federal Reserve, which is a very carefully managed institution for all the right reasons. And so that started summer 2019. And if you think back to summer 2019, stablecoins had come out. The Libra project was just about to be announced. I knew about it. And so you had the full force and might of what is now Meta building some type of digital dollar solution, or digital SDR, maybe, if you want to call it that. You had stablecoins emerging, and then you had what had gotten more public was the People's Bank of China, where it had been working on a digital yuan for somewhere around 5 years and had nationalized somewhere between 500 and 1,000 top engineers in the country to build something that could be at least used for domestic digital yuan usage, if not for an exportation along the Belt and Road Initiative. And so those things combined made it just kind of a really exciting thing. And as a founder of a team, the other exciting thing was building a team of great engineers. I had always been on the legal side of the house, and trying to get world-class engineers into a government service type job in which they're turning down multiples of that salary. Instead of going to Google or Coinbase, they're going to an office at the Federal Reserve Bank of Boston and working with the tooling we had available to what tooling we could get. And the most interesting thing from the jump, not related to the currency at all, was if you find a giant hard problem, there's no limit to the quality of engineers you can get, right? There's a lot of places world-class engineers can work for a lot of money, but there's only few opportunities where they can fundamentally change the world or have an opportunity to do so. That was the most exciting thing, like unquestionably. Now, what did we learn along the way that I think that was important? One of our theories was, can we have a form of the US dollar in a digital form, in a digital form that we can protect and double spend? Like, can we make it secure? Like, the first thing we had to worry about was security, because if you get a dollar that gets devalued through digital means or through hacking, it's game over, right? And you can't like roll back the dollar the same way you kind of roll back SWE a couple weeks ago. It's just not going to happen. So what does that look like? And so that's when we were really fortunate to get a bunch of Bitcoin core engineers, actually, who had been maintaining security of Bitcoin for upward around a decade, to actually start thinking about what security measures Bitcoin has, what security measures they work on in Bitcoin core, and can we put that into a dollar-like instrument? That was really cool. And then the question was, okay, if we're going to build this thing, what are, and again, assuming that Congress would have to prove this, what's the most expansive powers Congress could give us? And then how do we design it in a way that can handle all those expansive powers? Because you can always restrict. And so then we got to the point of thinking, truly, can every human that has access to the Western internet, and you're starting to think about WhatsApp membership right there. So you're thinking somewhere around 3 to 4 billion users. Could they all click send on a dollar app at the exact same time? And would the system not have a latency issue? Right. So and so we started thinking about what were the closest examples. So we went back to, at that point, 2019 Singles Day in China, or 2019 Singles Day in China, WeChat Pay got to somewhere around 500,000 TPS. Said, okay, if we're assuming the PBOC is hiring the top engineers from WeChat Pay to build their thing, well, America's not going to be worse than them. So that has to be our seller. We have to get a minimum 500K TPS. And that has to be geo-distributed. We're not talking like a Fogo style single rail in a NASDAQ, black box. This has to be distributed around the world on multiple AZs and standard type stuff. So either AWS or GCP. Can we get that 500K TPS using all the double spend protections that Bitcoin has? And so we really went back into the Bitcoin code base in a lot of ways and just tore out everything that went to not double spend protection, but the consensus models, right? If you're assuming the Fed is running it, you don't have to have the Byzantine generals problems. You're trusting the Fed to handle the money. And so we got to a point which ultimately became a code base called OpenCBDC, where we were running a network globally on standard AWS systems that had about 2.2 million transactions per second. And we built all of that code in a matter of months. Like the actual release of the code took an extra 8 months, just because doing anything publicly at the Federal Reserve has to be done very carefully. And to this day, I have a massive amount of appreciation for the persons in Washington who have to handle, to your point, Chair Powell was dealing with the largest inflation crisis since Paul Volcker, and he had to deal with a bunch of nerds from MIT, plus me, messing around in code bases on C++. Like he had to handle 8% inflation, and his time was being bothered about by crypto, which I feel really bad about, because if you've ever met Chair Powell, if you ever worked for Chair Powell, he's the kind of leader you run through a wall for. Like 100%, we're very, our generation is very fortunate to have him as the chair of the Fed. But it was really exciting. We effectively learned how to linearly scale UTXOs, and we published all that. And the other thing is we published it in open source. And open sourcing code like that as part of government is also something totally new. And the amount of phone calls our team would get from the DARPAs of the world, the NSAs in the world, and those engineers who have worked their whole career effectively in silence, seeing code get published publicly, they were really excited about. And so it was a really wonderful thing for not just our team, but all those engineers in federal government service or Federal Reserve type service whose code hasn't been able to be made public. They were really excited for us. This now may be a thing. So that was really cool. So we got that all out. And okay, we think we know how to linearly scale UTXOs, but what if Congress wants us to have something more expressive? Say something that has programmability features that might be interesting. So then we scrapped everything and went right back to our workbench and started working on, can we literally scale smart contracts? And that was what's called Parsec. And we got the EVM up to about 118,000 transactions a second, which, we started designing that in 2021. Since then, parallelized smart contract execution has become a pretty common thing. You have shops like Monad and MegaETH working on that type of code. But the EVM at 118,000 TPS was pretty cool back in 2022. And then we got that out there. And then, the Federal Reserve has really 3 main jobs. One is stable prices, which is extremely hard to do. The second is full employment, which is maybe even harder to do because they don't really control a lot outside of the fiscal side, right? And then third is retaining an independent Federal Reserve. If someone asks me one reason why all the CBDC efforts stopped, it's if you think about CBDCs even remotely having a retail application, you'd start dealing with people. And when you're dealing with people, you end up dealing with politics. And the one thing the Federal Reserve is extremely careful about is retaining its independence. And if you're dealing with people on a day-to-day basis, it's really hard to avoid getting into political type decisions, or I'll just call executive branch type decisions. And I think that when the rubber hit the road in CBDC, it was, is there a risk that this is going to pull us into politics or lose independence? And what's the trade-off for that? And I just don't think there's a compelling need for a CBDC at the risk of pulling the Federal Reserve into politics. And more often than not, major changes in financial architecture, whether it's Fed or not Fed, happen as a result of a crisis. And there may have been a chance of a Libra, we'll call it a crisis, although I'm quite positive of the Libra work that was done, or an ECNY crisis, but those crises never emerged. But the cool thing was, one, we were ready with the code. Two, we were able to bring in absolute rockstar engineers into the federal government and have them build really cool open source code. And three is I got to work with my team that I'm still with today here at Radius, which I'm very thankful for.
When you characterize all that, I hear a process of some very passionate and knowledgeable people that wanted to purely explore technical feasibility of a very innovative technology that is distributed ledgers and blockchain. And you got pulled into this world where you came from the private stablecoin side of things, and now you're exploring, let's just call it, public stablecoins or CBDCs. And as you started to hint at there, and I want to tiptoe around this, but obviously I'm sure people are listening to this, and when they even hear the word CBDC, there's probably some knee-jerk reactions. But to my understanding, it was extremely public. Like you're saying, you're publishing all the code bases, but it feels like when I just hear the heuristics of, oh, well, if we implement the CBDC, we're going to erode and destroy the commercial banking private system, and those sort of knee-jerk reactions. So I would just love to just hear your reflection on all of that and how it became this loaded word.
It's super interesting, and I'm sure there's way better political theorists than I that can think of these things. The first fight came heavily from the commercial banking sector, that we were going to disintermediate the banks. And that's a possibility, but there's a lot of ways you can work with code to make that not the case. Right? The Federal Reserve has done multiple studies about the effective illiquidity of most Americans. Most Americans don't have a lot of cash. And if you had a CBDC that effectively gave them a risk-free version of value transfer, and you cap the wallet at, say, $2,000, $3,000, you would handle most Americans' cash needs. And as almost anyone can tell you, finance is most expensive for those who have the least finances. And so you give people a $2,000 cap wallet, I don't see what bank that disintermediates. Maybe it disintermediates some banks that maybe are taking advantage of that crew, that type of American. And that's a very simple code you can put in. And you can inflation adjust that so those Americans can have a free wallet on their phone that buys their goods. I don't think that's a crazy thing to ask for. On top of that, you have what I would call a 3 to 40% tax on all goods based on card fees, right? So your local bodega in New York, if that's where you live, you want to buy a case of Modelo, you're spending an extra 3.5% because the bank's getting 3%, the POS is getting 25%, and the card's getting 25%, right? And so for most Americans, it'd probably be better than not that they're not spending that extra 3.5%. Were there a method of payment that is readily used around the world? But we live in a democracy that has lobbying, and lobbyists are really, really strong. And my favorite example of this was when I was going through this process of the Fed, just talking about code, a question I would get multiple times, both from industry, but also governors of the Federal Reserve System themselves was, tell me how this doesn't destroy every small bank. And it's a great question. Now, the question, why we have a legislative reason to protect small banks is a great question. And I think anyone who deals in Washington understands the power of the independent community banks, right? They are absolutely a force in Washington. The funniest thing, and these questions generally came from persons on the right side of the aisle. What's most impressive is I was in Washington 3 weeks ago talking to the Hill about stablecoins, and the exact same questions from the left were, tell me how stablecoins don't destroy the community banks of America. So the most fascinating thing is we found the one thing Republicans and Democrats universally agree on is nothing can possibly threaten independent community banks. They are the group that cannot be touched, which is really, really fascinating. And I'd be really curious to hear other guests that you've had in the past with these types of conversations of, to what extent do we calcify our financial networks in order to preserve a single industry or a single compartment of a single industry. Because I know they're not threatening JP Morgan Chase. I know they're not threatening Citi. But, and I started my career as a community bank examiner at the Office of the Comptroller of Currency. So I've been deep inside these organizations. I don't know the policy reason why we calcify our financial system for those organizations. But those organizations do have the influence that in 2022, I'm being grilled by, I say, persons affiliated with the right about why you're destroying community banks. And then in 2025, while advocating for the Genius Act, I'm also being accused by the left of destroying community banks. So it's remarkable, but what a country. What a country.
Yeah, 100%. So, okay, well, we'll continue the career trajectory there, but I do want to pause and just ask if you could just speculate a little bit on what you think is the current perspective on stablecoins, distributed ledger technology, blockchains, et cetera, from the Fed perspective, and just in general, as you've mentioned, you've been up on the Hill talking and consulting as the Genius Act starts to work its way through Congress. And the way I think about it is obviously there's the private stablecoin design, i.e. USDC that you worked on. There's the CBDC side of things, which is just a digital dollar. There's this whole other world, which is probably quite familiar to our audience here in terms of just implementation of monetary policy through, protecting of the quarter, the Fed funds rate through a variety of different, rates on reserve balances and repo, et cetera, et cetera. And so as I look across the cross currents of all of those, I'm curious, what is your current perspective you think on, obviously there's a lot of excitement and appetite around stablecoins in general from various points of the political aisle, but yeah, what's your high level perspective on where things stand today?
Again, I am not an economist. And once you work at the Fed, you learn very quickly to say, I'm not an economist and I have no statement on monetary policy. But what I can talk about on the anthropology of the organization is you have two distinct groups. One is the payments directorate of the Federal Reserve. And they're incredibly important. So all the drama you heard about master accounts over the last several years, that comes from that directorate of who is permitted to have access to the Federal Reserve payment systems. That's incredibly important. And that goes from everything from cash, wire, ACH, master accounts. That's all ran out of one group. And then you have monetary affairs, and those are the economists. And I think those are two separate questions with regards to stablecoins. I think the economists, and there's work being done at MIT on this, and that's why I know a little bit about it, is kind of related to Basel, the Basel standards, right? When the Basel Committee said X, Y, and Z assets have a lower capital treatment, that distorted the market for those assets, right? And so, for example, when the Basel Committee said certain types of mortgage-backed securities were a zero risk rate or X risk rate, people jumped into those assets because they had a higher yield than the other ones, right? So if the Genius Act or things like the Genius Act decide that this fast-growing asset class can be only collateralized by, say, treasury bills or reverse repos, well, that's going to distort the market. And so I would be shocked if the economists at the Federal Reserve aren't doing the same thing the economists at MIT are doing, which is modeling stablecoin growth and the markets for reverse repos in those bills, right? I think that is a very reasonable research effort that's going on. And there's no place in the world with more and better economists than the Federal Reserve System, right? It is kind of Shangri-La for economists. On the payments directorate, that's a totally different conversation, right? What does it mean if dollars move outside of their purview, right? I think that's incredibly critical, and it's a credible change to the dollar system. If dollars are become bearer assets or synthetic bearer assets that are not monitored and controlled, as opposed to messaging between what I'll call repositories of dollars via, say, SWIFT or ACH, that are either happening in the reserves accounts of the banks or in large international banks, that becomes a fundamental change of oversight. And my hunch is the economists can probably wrap their minds around the change in the market for, say, T-bills and reverse repos. But the fundamental technology change that is leading to new pathways for dollars to move around the world is probably causing a little bit more discomfort or agita in the payments directorate, because they need to rethink how they do what they do. But again, one really cool thing with the Fed is how collegial it is. And people tend to spend 30, 35, 40 years there. And so more often than not, what you're doing that you think is really exciting and cool, that person has done 3 or 4 times, right? So when we were building Hamilton, we went and met with the head of all payments at the New York Fed. And he was back there since 1972, digitalizing everything, post paperwork crisis, bringing, FedWire that's been around since 1918, bringing that up to the computer era in 1972, right? That guy actually built CLS Bank post house debt, the house debt failure, right? And so we were talking about CBDCs, like that's just a new ACH, that's just a new CLS. Like this, nothing's new under the sun, which is really cool. But these types of changes do cause agita, and they can be complicated to the persons involved. What's really cool though is you can find people that have been through a similar type of experience, and they'll calm you down and say, "This is fine. Here are the risk controls. We can solve for this." Who was really helpful with this was Eric Rosengren. So Eric Rosengren was the president of the Federal Reserve Bank of Boston when we launched our project and proposed it. And he was the first one to say, he was kind of the wizard on money market funds inside the Federal Reserve System. He led a lot of the 2008 crisis issues with the money market funds breaking the buck, and took a look at stablecoins and said, these look, act, and smell a lot like money markets. Tell me why they're not. And if they are, we have a pretty good idea on how to handle these things. And so I think you have a lot of people like Eric Rosengren and still inside the system who say, okay, these, not to use the Gary Gensler term, but these look like a duck, quack like a duck, act like a duck. The banks are getting a lot of agita because they're pulling money out of the banks. But at the same time, these appear to be fully collateralized. These are solvable problems. And my hunch is those types of veterans within the system are saying these are solvable problems. Let's just identify the risks. I think the one risk that is new is the propensity for stablecoins to exist on public blockchains and the learning curve to understand what I'll call the operational risk of public blockchains, right? The Federal Reserve has a long and storied history of analyzing and modeling operational risk, which generally means risks associated with non-financial matters, right? So legal or technology. And what type of capital buffer do you have to put on, say, Tron versus ERC20, right? That is a question that hasn't been solved. I think smart people are asking these questions, but there's going to need to be some type of capital buffer. Again, Jeremy's going to kill me for saying this, but I think there needs to be some type of capital buffer on public blockchains running stablecoins because there's real risk there. Blockchains are not, people say blockchains are mutable. They're not, they're code. And there's people maintaining that code and there's validators in that code. You've seen how many public blockchains that were decentralized have been totally rewritten in the time of crisis. Bitcoin still is not immutable. I think people have a false belief it is, but Bitcoin breaks all the time. There's just really smart people fixing it. So they're not perfect. And so there's risk there. And if you have real money on top of it, you need a capital cushion for it. And again, people in the system know how to solve for that problem, and I'm sure they're working on it.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. I'm glad you brought up the comparison to money market funds, because that's exactly how I've been thinking about them myself as well. And it feels like a lot of other people are. And it just feels like a new version of that. But the one distinct difference between the two is where the yield goes. So these stable coins are not yield bearing. And it appears that if the Genius Act gets passed as it is existing today, they will not be allowed to pass on any yields. So I want to bring that and throw that at you and just get your take on why that is. If we want these to be the new version of money market funds, but then we don't allow people to actually get a yield on them, how could they actually be a money market fund if all the yield is just going to the
Yeah, and this was one of the first battles we had when trying to design USDC. Was, Tether had been out there, but Tether wasn't even attempting to go into any kind of regulatory remit. I think Paulo and his team were just solving the problem of the trading desks and exchanges. But when we tried to take this very seriously. We hired, in my esteem, the best firm in Washington for this. We spent a lot of time inside the halls of the SEC and the Federal Reserve. Just the way the laws work is if you have a derivative of a security, you're a security, right? And so if you wanted to have some type of stablecoin that was backed by government bonds, and you're effectively putting a synthetic government bond out there, you can't put a security on a new type of technology and call it not a security. It's still a security. And we worked really hard inside the halls of the SEC during the first Trump administration to get any kind of clarity on this. And we spent a lot of money on a great law firm who worked really hard for us, and we got nowhere. It was really, really hard to get that version of the SEC to see where we were trying to go. And I'm sure other firms have these same challenges. But then the question is, if it is a money market fund and you are offering it yield, can it move on the same rails? Can it move between the same parties? And obviously legislation is changing and guidance is coming up from Chairman Atkins's office that might change these things, but they don't move the way they do if they're securities, right? You're not offering DeFi products in 2018 if they're securities. And a lot of that led to why stablecoins were heavily into banks. Right? Stablecoins were into banks because that was the safest place to put the money that didn't immediately call them securities. Bank concentrations is a wholly different conversation. When we were looking at designing USDC, we really wanted 37 banks because that's how money markets split their bank accounts. But there wasn't 37 banks in America with risk appetites or legal divisions or compliance divisions or lawyers that would give them clarity on could they hold these things. And I think people talk about stablecoins causing bank crises. I don't know if I'm kind of with a point where it was the bank's management of the reserve assets behind the stablecoins that caused the problem. And I know I was at the Fed when those broke, so I had no inside baseball on it because I was in totally different directorate. But I think that's a great conversation for historians of like chicken or egg there. But offering yield, you also get criticism from persons in the banking industry saying stablecoins don't offer yield, and that's a problem. But I don't know anyone who has a checking account that gets much yield, right? Banks can offer some yield, but I know what my corporation's reserve gets from its bank, and it's zero. And there's a lot of money in there. We still get zero. So if I don't get that argument either. Whether I think there might be products that offer yield. I'm really hard to see how they're not securities though. If they're offering yield, I don't know how you get away from the security question, aside from very specific guidance on it. But my hunch is if you're offering yield, you look a lot more like a stablecoin than if you're not.
Okay, when I hear your whole journey, it characterizes itself as somebody who often skates to where the puck is going ahead of time of a lot of different people. And so we found ourselves in the present day, and I want to hear more about what you're working on today, what gets you excited, what problems are you solving? So you're the CEO and founder at Radius now. And yeah, just based on all of that, I just want to hear about what problems are you trying to solve today and what's got you excited?
Yeah, kind of going back to our theory about the eras of stablecoins, right? So, I was on the Circle trade desk when we were one of the bigger users of Tether back in 2017 because it worked and because bank wires had a big latency problem. And so the Tether team did solve for that problem. And Circle's team in 2018 really solved the DeFi problem. And then in the next administration, a lot of that team, particularly the policy team, pushed for the remittance solution. I think now there's a really interesting solution happening, which is what I'll effectively call the stable card era. And this is how we think about where stables are going right now. And you're starting to see traditional fintechs, namely, the one I'm most excited about is Stripe, because I think the Collison brothers are the best in the game at fintech, which is taking a look at that 3.5%. That is effectively a tax in all commercial activity, at least in the United States, if not in most of the world. That, Bank X gets 300 basis points, Stripe gets 25 basis points, and Visa gets another 25 basis points. And questioning, well, why does the bank get the 300 basis points? Is it for lending or is it for the availability of money? And I think for most card transactions, they're going to say that's a payment mechanism, not a credit mechanism. And so do you need to give Bank X 300 basis points? I think smart people are asking that question. And then if Bank X is moving that 300 basis points, do you need Visa to be the messaging system between Bank X and Bank Y? If you can replace that bank with a stablecoin and you replace Visa with some type of distributed network, whether it's a blockchain or some type of stablecoin network. I think smart people are asking that question. Because if you look at operating margin, no one's better than the cards. The cards operating margin has, for the last 20 years, has been by far the highest operating margin on the S&P 500, and it's not close. Which means it's a really darn good business, but darn good businesses get competed against, right? And so I think Stripe is taking a look at Visa, and those types of companies are saying, okay, we know that Bank X is just charging 300 basis points to the end user for payment. We have a payment instrument called stablecoins. Maybe that will work. And two, we know Visa's charging 25 basis points for messaging. And then we are the POS. We own the POS and the UI. Okay, so can we get, how low can we get this number, right? And you can get pretty low. Like Walmart and Costco get down to about 90 basis points because they just squeeze everyone because they have the size. But your corner bodega can't do that, right? And if you're in Brooklyn, you're in Cambridge where I am, and I'm getting a Coca-Cola for my kids and I use a card, that's a 3.5% tax. So I think Stripe is thinking about that and understanding, can you bring, and this is not inside baseball, but if someone does need the credit side of the credit card transaction, can you add a Klarna to the stack, right? Klarna and Stripe are already working together. Can they add 40 bips on the credit side? And now you're looking at 65 bips with credit involved as opposed to 350 bips. I think that's a really good conversation. So I think that's where the puck is right now. I think really smart people inside Stripe and companies like Stripe are asking, why do we need to pay 350 basis points on a transaction when stablecoins and stablecoin networks can solve 325 basis points of that? And I think that is a critical good. And people ask why stablecoins, why financial technology? That is a critical good. And one thing that drove me crazy inside the Federal Reserve, not that I'm a monetary economist, not that I'm smart enough to be angry inside the Federal Reserve, but one of the things that would pull my hair out is us having genuine conversations of what to do about 8% inflation. And we're staring in the face of 3.5% of that for most retail goods based on card networks and banks. And most Americans don't have that much money. Our economic situation is pretty broadly gapped. And if you can save 3.5% on most loaves of bread, that's a really good thing for a lot of people. And I think people like Stripe get that. So I think that's what I'm calling the stable card era. And that's right now. That's happening right now. In the next 18 months, that is happening. We're thinking next, right? So the main focus, Radius launched in 2024. We're building it all off that Parsec code base we built with MIT as part of the Federal Reserve project, which is, can you linearly scale stablecoin execution? When I say literally scale stablecoin execution is, as you add more compute, can the stablecoins move faster and can they get cheaper, right? So right now, the cool thing is most stablecoins are running on the EVM. So I think 98% of stablecoins all run on EVM-based networks, right? So we've built our entire company based on the EVM because the tooling is there. And can you get into the millions of transactions per second, like we did with Project Hamilton? And can you get a cost level in the hundreds of thousands of tens of thousands of a penny? Because what gets really interesting there isn't just driving standard card swipes to zero cost or infinite speed for settlement. What gets interesting is you can start changing digital incentive models. So if you talking about where the puck is going, one thing we think about is what are the most high margin activities out there that exist but for the absence of a technology. And where we were really inspired on Hamilton was two concurrent speeches that happened within a week of each other in 2019. So in 2019, two speeches came out for about 4 days from each other. One was Mark Andreessen's original Sin of the Internet podcast. It got made really, really popular more recently with the Coinbase developer platform's X402 protocol, where they really talked about this at depth. And that team is like, we really look up to the Coinbase Developer Protocol team. This guy named Eric Greppel and them are really, really good. And the whole point there is what Andreessen goes at length with is when he was developing Netscape in 1998, he banged on every single door in the financial services sector, from banks to Federal Reserve to card networks, saying, we've built this really useful digital network called the internet. We're making it really user-friendly. We'd love there to be native money on it. And everyone just told him to pound sand. And so he talked about this 20 years later at this podcast in 2019 in late August, saying, but for us having technology, because we didn't have the technology to move money on this layer on the internet, smart people at Google, and later that woman went to Meta, built something called AdWords. And so now we have this original sin of the internet, which is effectively the attention economy, or AdWords. It's also a massive business. It's Google's primary business. Everything else at Google lives for that. Everything at Meta lives for selling ads. And also, as like a parent of 3 kids, I think about how much time they're pulled into the phone. I think how much time I'm pulled in the phone, because the attention economy is really what drives several of our largest corporations, is a sale of ads for incentivizing the internet. And so, Andreessen went to this, but for us having effectively linear to scalable data systems or value systems that move as scalably as TCP/IP, we have to use this weird barter system with ads. The other really interesting thing is Carney, who at the time was the head of the Bank of England, gave a speech and at the Federal Reserve Bank of Kansas City, Wyoming event, Jackson Hole event, which said that we are nearing a point of currency conflict. And we need to get our minds wrapped around, what does currency conflict look like? What tends to happen during currency conflicts? And how can central banks get themselves ready for currency conflict? Background on that, apparently no one knew he was giving the speech. It was the last speech he ever gave as head of the Bank of England. He didn't run it past anyone. Everyone was kind of silent and shocked in the audience when he gave the speech of, the dollar is nearing its end. And usually when currencies change, we have a world war. So can please the central banks who are in the room here and the governments that support them, can they get together and figure out what are we doing so we don't have a lot of people die? And so those 2 speeches came out about 4 days from each other in late August 2019. And they've been a real foundation of how we think about what we build. And so when we think about what we're building here at Radius, one is we've been laser focused on building a linearly scalable smart contract execution network that's effectively free. We are in the multiple millions of transactions per second in our testnet, and we're running about 10 million transactions per dollar. So we're nearing free. And as we add more compute, it tends to scale better. We're really excited about that. The most exciting thing is the use case, which is if we can linearly scale value transfer, we can fundamentally change the incentive model of the internet. I don't know about how your team works, but I spend most of my time on the internet now on Claude or OpenAI or Cursor. So what does the attention economy look like if we're not clicking and eyeballing? How does the internet incentivize itself? And can we actually use stablecoins as a mechanism to free ourselves from that hamster wheel? And so as we think about how we describe ourselves, one of the things we start talking about is letting humans do human things again, which is, can you actually get, as a father of 3, can I get my kids away from the attention economy that Zuckerberg so wants them to have and be attached to? Right? Is there a way to incentivize the internet that doesn't involve eyeballs and clicks and swipes? That's really, really exciting. And we think stablecoins are a mechanism for that. Now, the buzzword you're going to hear about this is agents, right? Is if agentic systems or actors on top of AI models can use compute, use data, use inference to do things for you or do things amongst themselves. And generally speaking, that would be buying data, buying compute, buying inference, or selling those 3. Can they do so in a way that has a native currency? And this is where kind of the Mark Carney thing comes in, which is whatever currency figures out to be the mechanism by which this economy buys and sells things from each other and replaces AdWords, that will probably be the default language or the default model of this new version of the internet. And that's where we get really excited, right? So, this won't, we're already hearing about OpenAI working on ad models, which for me is a failure. For me is repeating the failure. And we're working like hell and sprinting like hell. We raised our last round from Lightspeed to stop OpenAI from using an ad model, because then we're just attention economy all over again. And we can't have that. Like we have to have agents doing this stuff with authorization, with permissioning, with identity, so we can get away from our phones and get away from our screens. Like that 20-year experience or 25-year experience of being attached to a screen is really suboptimal. And we think stablecoins can do this. Now, we do think there's a bet that Bitcoin might be able to do it because, you know, our whole team is big Bitcoiners. It's really hard for Bitcoin to scale. One of the inventor of Bitcoin Lightning was part of Project Hamilton. So we know him well, and we really love the idea of Bitcoin being a censorship-proof way to do this. But our bet is on USD stablecoins. But if USD stablecoins are not this mechanism, there's a non-zero chance that another actor comes into play. And the only actor with liquidity to do so is China, right? And one thing we've seen for the last 15 years is China does not play what I'll call standard geoeconomic games. Like they play asymmetrically on geoeconomics. The ECNY is currently in the backend code of multiple central banks around the world via the mBridge project, right? If you go to the BIS, they talk about mBridge being the future solution of central bank money. And mBridge is just ECNY, you know, PBOC code. And like that, they're doing the smart thing. Like they're not asking permission at multinational meetings to do something. They're just building really good code. They're hiring really smart people, and they're solving the problem. And so the other thing, like we're very shameless, like pro-Americans in this team. The dollar's a good thing. America's a good thing. We do believe that. And so someone's going to fill that vacuum with AdWords. Either it's going to be some open AI model of AdWords, in my mind, is going to suck us right back into the screens, or it's going to be USD stablecoins or ECNY. Alternatively, it's Bitcoin. I'm okay with the Bitcoin model, but I'd love it to be the USD model because I think there's a really, really interesting future of that. So that's where our heads are. That's where our focus is. If we can linearly scale the networks that support stablecoins and make them effectively free so that you have about the net amount of API calls per day be the same as agentic interactions, you can start getting natural markets for data, compute, and inference. And that's super exciting. So that's what we're doing. That's our sole focus. We're going to ride over the cliff going for that. That's our vision, you know, and so we're going for it.
Yeah, that is absolutely fascinating. I had no idea that the ECNY is being utilized by different central banks now. I feel like a lot of people aren't aware of that fact. So I feel like that's absolutely fascinating. As we start to wind down here, I would love to just hear about, obviously you've hinted at a little bit about the your 10 years out perspective on where things go here. And I'm just curious to hear a little bit more about the game theory involved in terms of where you think we go from just a 30,000 foot view of just the crypto industry, where the different components of it sit out. A lot of the audience that is listening to this will just be mostly like crypto curious of sorts. So I just would love to hear about, how do you think all the pieces of the puzzle come together? Do you see these as further supporting the US dollar reserve hegemony? Do you see it as being the potential for the unwinding of other different fiat currencies as it consolidates into the US dollar? Or do you see the opposite? Where do components like Bitcoin sit within that whole framework as well?
The way I think about technological progress is it tends to lead towards standardization, but for artificial impediments. And when I say artificial impediments, I usually mean law, right? And so at least in the United States, for the last 25 years, we have been running parallel tracks in financial technology and everything else. And because of that, the US has actually limited its role in the global financial system. We've actually kind of held back the ability of the US to export its financial system because we've been very much limiting that financial architecture to the Federal Reserve System and members of the Federal Reserve System. If this administration kind of keeps on path of either promoting or just getting out of the way of the emergence of emerging technology being financial technology, I think there's some really interesting things down the path. One is what I just talked about. I think there is a world by which the bank card stack really gets disrupted. And I think banks that do lending will be fine. Banks that offer great customer services will be fine. But banks that focus on cards, I think there could be disruption there. Definitely the cards themselves could be disrupted, but they're technology companies at their heart. They may jump into this game. But are they willing to cannibalize their entire business to do so? I don't know. I think this will disrupt AdWords. Like that is one of the goals of our company, is to disrupt AdWords, full stop. So I think that's coming. I think the third thing is something we raised inside the Federal Reserve System, and it was always a very uncomfortable conversation. And is the question of how many currencies exist in the world in 2050? And I think this is something that you look at every technology system. If you look at the internet or you look at the code of the internet, the overwhelming majority of the internet is in English. Almost every coding language is in English. That is not an accident, right? Primarily speaking, English-speaking countries built this technology, and what emerged was English being the lingua franca of this technology. That is the standardization. Money, if it becomes natively digital, will start standardizing towards certain economies, but probably only those economies have liquidity to handle it. So what does that, and ideally those that are stable. For unstable economies or economies with unstable currencies, if their persons have a legal ability to get access to a more stable, deeper, more liquid currency, they may go to that. Right. So what does the Western Hemisphere look like in 2050? How many countries are dollarized by 2050? I think that's a great question. My bet is most. Maybe Brazil hangs in there, but most probably get dollarized. What does the eastern part of the world look like? Does China start exporting because they have the deep liquidity markets? And my bet is by 2050, you probably have 6 or 7 currencies left in the world. Like, that's my big bet, right? You probably have the yen, you have the yuan, you have the won, you have the pound, you have the euro, you have the franc, the rupee. And let's see what else is in the dollar, and let's see what else.
What about BRICS?
You're really making a big bet that those very different countries get along with each other, right? Right, like you know, we have the Five Eyes in the United States and they all happen to be English-speaking Commonwealth countries. I don't know if you noticed the last year, but us in Canada really aren't doing that well right now, right? I've never seen a Stanley Cup like this one between Florida and Edmonton, right? And you're Canadian, right? So you know this.
Yeah, I get it. Yeah.
And so if us in Canada can't get along right now, what hope does China and Brazil have over that course of time with that depth? Maybe they'll do great, but I think making 5 very different countries get along on a currency standard would be really hard to do. Really, really hard to do. But what happens to Latin America? What happens to Africa? What happens to Southeast Asia? I don't know. But if history is any indication, history tends to standardize. Technology tends to standardize things. And if currencies are deep and liquid enough and can be standardizable in code, I just don't know how that doesn't happen. And way smarter economists than me can talk about the trade-offs there and the results to local economies and communities. And I have never lived anywhere but the United States, so I've always had relatively stable currency. But I think that's the one thing that people aren't talking about enough, is as currencies get natively digital and move over open internet networks, what happens to local currencies? And I think what you're going to see is certain internet networks no longer be global, right? So China has its own internet. Certainly regulations in Europe are coming out to give it its own internet. So maybe they can persist in establishing a currency standard within those zones. But if there is what I'll call a default internet that is American run, I don't know how you get away from not having standardization in currency. And I think that's the big what if that economists who are way smarter than me need to start modeling, because I think that's a really interesting conversation.
Robert, that was a fascinating hour. Learned a lot. If folks want to hear more about what you're building, where can they go find you?
Yeah, so I'm on Twitter at RKBench. Our website's radiustech.xyz. We're pretty open, pretty transparent. DMs are open if someone wants to reach out. But importantly, I appreciate the time. You know, having these types of conversations, I don't think were possible 20 years ago. Like, you had to go on Louis Rukeyser, have this type of conversation, and I'm definitely not qualified to be on that show. So thank you for the time. This is awesome.
Oh, my pleasure. That was absolutely fascinating, and just so great to hear some of the lessons you learned and what you're excited about.
All right, cheers, man. Take care.